Welcome to 360 Degrees podcast series. My name is Tony Mliro Wabomba, and today I'm going to talk about loan, whether we should take up a loan or not. And the question is both way. You can take up the loan or not. So, what is a loan? A loan is basically financing from a financial institution, could be a person uh, that gives you money with the aim of recouping the money back after some time, together with an interest, which is basically the income for that person or institution. So, why should you take up a loan? You should take up a loan basically because uh, of a need, or if you are in business, you've come up with a good plan and you want to execute and you want good financing, then you can take up a loan to finance your business. But again, you have to ensure that the business has enough, can generate adequate cash flow to sustain payment of both the loan and the interest that is over the period for which you've taken up the loan. So that's one area you can take up the loan. Uh, Another one is if you are going to buy land and you want quick money to buy that piece of property, then you can take up that. Some have taken up loans also to pay school fees. Some still have taken up loan to finance their wedding, which I'm not saying is a bad thing, but again, you need to be in a position to be able to pay up that money, whereas and when they fall due in terms of interest and the loan that is payable per month, or whichever period you've agreed with the financial institution. Another thing maybe you should consider is the cost, which is the interest. Some organizations will charge you a higher interest, especially if you are not giving out collateral or security for taking up that loan. So you need to look into that because you also want to ensure that you are better served with the money. But again, you also want to look at your case, whether you have a security to back up that money in case you default on payment. So that's why you'll see some institution will charge you a higher rate, and it's a trade-off. You have to decide you want the loan or not. And in most cases, if you don't have a collateral, you're likely to take it because there's a need you need to take care of. And then security. Some loans may require that you have to provide something, security, so that it can be a piece of a title deed for a piece of land, could be a logbook, could be certificate for investment you ordered somewhere. You can take that to a financial institution and they'll be able to give you a loan. But again, they'll also look at the liquidity. In your case, they'll ask for your bank statement, or for those who have M-Pesa or mobile payment platform, they'll ask for statements. Could vary from 3 months to 6 months. So this will depend on various institutions. So look into that. If you're able to provide such information, then you can also qualify for loan. And then another aspect of loan which you need to consider is the term of the loan. Those who take up loan for a short period, less than a year, or for a longer period. This will depend also from institution to institution. So when you're taking up a loan, also consider the duration of the loan you want to take. Of course, if you take a shorter period, it means you'll be paying more in terms because the period is shortened and not spread out like if somebody was to take up a loan for more than a year, of which you will pay relatively a small amount over a period of time of that loan. So look into that when you're taking up a loan. And then there are those institutions that basically just take loan from or advance loan to specific people. Be cognizant of that. It's about minimizing risk on their end. So like those who are targeting government institutions, those are basically, in most cases, they don't require collateral, and they will tend to target such institutions because they are more safer for for them. And then there are those that are targeting everyone. As long as you have a business and you provided the cash flow history of that business, they're able to advance you with loan. So in short, loan is not a bad thing, it's a good thing. And in fact, in some jurisdiction like Kenya, jurisdiction like Kenya, for example, that word is a mouthful. Yes, like Kenya, for example, you're able to get a tax benefit for that. There's a certain percentage that is usually deducted when you're filing for return, so that to encourage many people to take loans so that they can develop their businesses and by far the country. So look into that. Ensure that you take up the loan for the right reasons. Also ensure that you have the ability to pay the loan, because you don't want this institution to knock on your door, because they'll take up calling auctioneers on you because you failed to honor payment of loan. So those are the takeaways in taking up loan. Loan is good, but take it for the right reason and ensure that you're able to pay the loan as and when they due, in terms of the loan amount payable per month together with the interest applicable to that loan. So that's all for today. I hope you learned a thing or two about loan and basically factors to consider when taking up loan going forward. So if there are any other perhaps factor I've left that could influence loan take up, of course, just hit the comment section and we'll have a very engaging discussion rather, and many of us will benefit from that information, because not everybody is privy to such information, and the more we share them, the more we are knowledgeable and we're able to make wise decisions as far as finances is concerned. Others from me, have a lovely day. Please go out there and make it a better place for you and me. Cheers.